I gave you two problems I wanted you to look at that had to do with the kiddie tax or the parental tax due to that calculation, and I wanted to make sure you understood that. So let's look at those two problems, and then we'll move on from there, and hopefully that'll help you understand that. Here's our formula, and we're going to look at problem 28 for our formula. We have Brian and Kim have a 12-year-old child, Stan. For 2008, Brian and Kim have taxable income of $52,000, so that's the parents' taxable income. And Stan has non-qualifying dividends of $4,500 and investment expenses of $250, so he has some investment expenses. No election is made to include Sam's income in Brian's and Kim's. Okay, so we want to start by looking at the unearned income calculation, which I had just fine on. It was the other calculation that I was throwing you off on, but we want to start here to come up with their net unearned income. So that's our first step. Okay, that's our first step, is that we want to start there. And so he had $4,500 of investment or dividend income, actually. And so our calculation tells us, and actually I can lay that up here beside it, sort of. We'll try to make it work. But we want to start off with our unearned income, and then we want to subtract the greater of $900 or allowable itemized deduction or investment expenses. They had investment of $250, investment expenses of $250. So the greater of the $900 or the $250, in this case, the $900. Okay, it's the greater of the two. Okay, and then we want to subtract the statutory deduction of $900. And so therefore we have net unearned income for Stan of $2,700. Okay, that's our first calculation. Then we want to take that and we want to start with this calculation here. We want to start with the parents' taxable income, and I can just write it on this piece of paper. The parents' taxable income was $52,000. And then we want to add to that Stan's net unearned income, which was $2,700. Okay, and so we get $54,700 as a new tax. As a new taxable income, I'm sorry. Then we want to calculate tax on that. We can look at the chart in the back. We get a new tax of $7,406. Okay, the new tax comes from the tax table, $7,406. The old tax, which would have been on the $52,000. The new tax is on the $54,700. The old tax on the $52,000 is $7,001. So that makes his parents' tax for Stan to be $405. So that's A was what was his net unearned income, and then B what was calculate the parent tax of $405, and then C calculates Stan's total tax for 2008. His total tax for 2008. So we have our $405. And then what we do is we add to that, remember the 10% of $900. So we add to that $495. We add to that $495. So that would be Stan's total tax, $495. So that's basically how you do the parent tax. Let's look at problem 29. We have Nikki and Jean have two children, Richard and Roberta. For purposes of the parent tax, Richard has net unearned income of $6,000 and Roberta has net unearned income of $4,000. Assuming that the total parent tax is $2,400, allocate the parent tax. And this one just had to do an allocation of the parent tax, and we can do it. It didn't take us through the calculation, but I'm hoping now you have a pretty good feel for that. They want us, we have Richards and we have Roberta. I'm just abbreviating here. And they want to allocate the parent tax. They have parent tax of $2,400 that needs to be allocated between the two. And this is when you have more than one child, so it does help go over the allocation. And so what we want to do is, Richard had $6,000, and Roberta had $4,000. Okay, the total is $10,000, and we want to multiply that times the tax. Okay, so given that, Richard's portion of the tax would be $1,440, and Roberta's portion of the tax would be $960. And so that's the allocation of the tax after it's already been determined. Once you go through the calculation, and if you have more than one, it just deals with the allocation. Okay, let's get back to our text. We're at the bottom of page 6-23. The bottom of page 6-23. So as you can see that there's a possibility that there's some parent tax involved. There's a possibility there's some parent tax involved. If you look at the bottom of page 6-23, there's an election that can be made. Okay, election to include a child's unearned income on the parent's return. Okay, so we could just simply make that election and just put it on there. But there's some things that have to be met in order to make that election. Okay, the things that have to be met in order to make that election, if you look at the top of page 24, the child's gross income has to be from interest and dividends only. Number 2, the gross income is more than $900 and less than $9,000. So income between $900 but less than $9,000. And that there's no estimated tax has been paid in the name of the child. So, and we're going to look at estimated taxes today. And that the child is not subject to backup withholdings. And we'll kind of briefly talk about that as well. They give an example. Sam is 12 years old and has $2,300 of interest from a savings account set up for him by his grandparents. Sam's only income for the year, so he had interest, $2,300. Instead of completing the kitty tax form, the 8615, and paying the tax on his $2,300 in income, Sam's parents may elect to include the $2,300 on their tax return, thereby eliminating the filing of the filing required. The election is the election to include the income of the minor child on the parent's return is made on the form 8814. So you can fill that out and just include it on yours, or you can go through and do the calculations and where they have the child do their own and fill out a form 8615. So those are your two options for unearned income. Okay. The last thing in this chapter is community property. Community property states, and how do we deal with community property income. Okay. On page 6-24, there's 9 states that are subject to these community property laws. Kansas and Missouri is not one of them. So I'm just going to do a brief overview since we won't fall into this. But Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, and Wisconsin. Wisconsin. And so basically in these community property states, the income is deemed community property, basically is deemed property that it's income that we earn jointly, you know. And then there's certain property that's either separate property, and then there's certain situation is community property, and then all that income from the community property is income that's going to be reported if you file a separate return, half on one spouse's return and the other half on the other, if it's deemed to be community property. Separate property is property that's acquired by a spouse before marriage. So that property is considered separate property, and therefore any income from that property is just on that one particular spouse's return. Or any property that's received by a gift or inheritance. So that property is considered separate property. So that particular property any income from that is going to be just reported on the one spouse's return. And then given that all of the property is presumed to be community, and so therefore any income from that property is going to be considered 50-50. Okay, 50-50. So let's look at page 6-27. Just a quick example. John and Marcia are married and live in Texas. John owns as his separate property stock in AT&T Corporation. During the year, John receives dividend of $4,000. Assuming John and Marcia file separate return, each of them must report $2,000 of dividends. On the other hand, if John and Marcia lived in California, and I'm going to deal with that in just a minute, John will report the entire $4,000 for the dividends on his tax return, and Marcia would not be required to include any of it. Okay, so we have these 9 states that are considered a community property state: Arizona, California, as I said, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, and Wisconsin. So those are our 5, okay, where we have what we deem as separate property, and then we have community property. Under those general rules, separate property is separate property, community property is community property, okay. Then if you look at the bottom of page 6-24, the tax treatment, they tell you, of income from separate property depends now on the state, the taxpayer's state of residence, okay. So remember, our separate property acquired by a spouse before marriage or received by gift or inheritance. So if you're in Texas, Louisiana, or Idaho, income from the separate property produces community income, okay? So if you are from those 3 states, Texas, Louisiana, and Idaho, even though it's separate property, separate income, they're saying in those states they have determined that separate property produces community income. So given that, the income from that separate property would be still split 50-50. Thus, just as each spouse is taxed on half the income from community property, each spouse would also be taxed on income from separate property. Okay. In the other 6 community property states, income from separate property is separate property and reported on that particular spouse's income. So, in our example, in the case of Texas, it is a community property state that treats separate property income as community income, and therefore they would split it. If he was in one of the other 6 states, then it would be 50-50. Okay. Now, in all our community property states, income from salary and wages is generally community property and reported half and half. So let's look at our example on page 6-27. We have Robert and Linda are married but file separate returns. Robert receives a salary of $30,000 and has interest income of $500 from a savings account which is in his name. The savings account was established with salary earned by Robert since his marriage. Linda collects $20,000 of dividend on stock she inherited from her father. It says the amount of income which Linda must report on her separate income return depends on the state in which they live in. Okay, if they lived in Texas, remember Texas says separate property creates community property, then the spouse or Linda will report half of Robert's salary, $15,000, half of her dividends that she collects of $10,000, and then half of the $500 from the savings account. So if it was Texas, it would be $25,250. If it's California, then she would report half of Robert's salary. She would report all of the dividends from her inherited property of $20,000. She would still report $250, half of the savings account. If she lived in Kansas or Missouri, which is not a community property state, she would only report the $20,000 worth of dividends. So that's a little different. Okay, a little different. Okay. They also talk about at the bottom of page 6-27, spouses living apart. This with community property issues only arises when spouses are going to file separate return. I wanted to iterate that. If they're filing a joint return, all the income is reported on the same return. So it becomes the issues when they're filing separate returns. Okay. They talk about problems that can arise when married spouses residing in a community property state do not live together. Okay? And then there's some exceptions to these community property laws that I just went to. And under special provisions, a spouse will be taxed only on his or her actual earnings for personal services. Obviously, they don't live together, so you don't want to be held to have to report income from another spouse. So for that provision to apply, you have to meet these conditions. The individual must live apart for the entire year. They must not file a joint return, and no portion of the earned income may be transferred between the spouses. So they can't transfer money to help take care of whatever. It can't be transferred. The example, Bill and Betty, they both are residents of Nevada and are married, but they live apart the entire year. Bill had salaries of $30,000 and Betty had salaries of $35,000. Normally, Bill and Betty would each report half and half of the salaries. However, if they meet those conditions, Bill and Betty would each report their own salary. If Bill and Betty had some unearned income, such as dividends and interest, the income would be reported under the general community property rules. So that only applies to those personal services. Okay, and that's earned income, so it wouldn't apply to the dividends and interest and things they earned. Okay, that's all of chapter 6. That's all of chapter 6. Okay, so let's just look at, I just have a few things in chapter 9 that I want to kind of go over. And then that will be all that we cover, and we'll kind of go back and review what we've covered. I'll go back and review what you should have turned in or need to make sure you have turned in. And so we'll look at that as well, so that everybody's clear at the end of class what should have been turned in and what needs to be still turned in. Chapter 9 deals with withholding and estimated taxes, estimated taxes, they call that as well. And we'll briefly look at payroll taxes, not in much detail. As we know that when you get hired on a new job, you normally fill out a W-4, which indicates the withholding. It indicates withholding that you want withheld from your paycheck, and it lets your employer know that I want you to withhold taxes for me based on a single tax rate and based on 3, 4, 5, 6 exemptions, 1 exemptions, or whatever the case may be. So basically, you normally fill out one for state and for federal, and that's going to dictate the amount of withholding that a company is going to take out of your paycheck. And they have a Circular E, is what the IRS publication is called, and that is a chart that they use that goes to it and says, okay, if I pay this person monthly, once a month, and they claimed 1 exemption and is single, and their income is between this amount, this is how much I withhold. So that's basically how you determine those withholding, how your employer does. They have a booklet or a chart, or it's done via computer. But you know, if you get paid by monthly, meaning twice a month, there's a separate page or chart for that. If you get paid weekly, if you get paid every other week, and so and it's based on what you put on your W-4, and you can change that W-4 within the year. Once you file it, you're not stuck with it. You can make changes to that amount and the exemption amount. You can change the exemption amount. Look at page 9-2. Okay. It tells us, would you believe, I find this very interesting, would you believe the former president of Sprint Corporation claimed approximately 300,000 exemptions connected to a complex tax shelter that eventually cost him his job, according to the Wall Street Journal, February 11, 2003. So I can't see anybody claiming 300,000 exemptions, but apparently someone does. Also, under tax break, it pays to fill in Form W-4 correctly. When taxpayers have too much tax withheld, they are giving the government an interest-free loan of the extra income tax withholding until their tax return is filed and a refund is obtained. When taxpayers have too little income tax withheld, they are subject to penalties of underpayment of taxes. So it is important that that you fill out your W-4 correctly. There's some calculations that you can go through to determine it. Like I said, you can make changes, but that's where they determine how much is withheld. If you remember on our very first session, how much you put in the cup every time you get paid versus what you owe at the end, whether you have a really big refund, and maybe that's your choice. But keep in mind, you don't earn any interest on that. So if you're getting huge refunds, and where it could be somewhere and you can earn interest on it, it's totally your preference. But just keep that in mind. Or if you're not paying in enough and you end up owing, and then on top of owing, you end up paying a penalty on top of that. Okay. We mentioned backup withholding. Backup withholding, page 9-6 at the bottom. Backup withholding is basically withholding on interest and dividends. And I have seen this to where normally you get a 1099 on your dividends and interest that you've earned. And on some occasion, people have withholdings taken out of their dividends and interest. They've earned a huge amount of interest and dividends, and so they take withholdings out, just as if they take withholding out of your wages. So they take withholdings out of your dividends. And banks and companies are required as payers to use backup withholdings in the following cases, meaning to withhold on those dividends and interest if the taxpayer does not give the payer his or her taxpayer identification number, if they don't give them their Social Security number, if the taxpayer fails to certify that he or she is not subject to backup withholding, if the IRS informs the payer that the taxpayer gave an incorrect identification number, or if the IRS informs the payer to start withholding because the taxpayer has not reported the income on his or her tax return. So in those situations, backup withholdings may be required. Okay, estimated payments. Some individuals, on top of the amounts coming out of their paychecks, they may have estimated payments paid in. Self-employed individuals make estimated payments because they don't have an employer in which they're taking out of their taking money out and paying it in. So they make estimated payments, and people who have jobs can make additional estimated payments as well. And basically, it talks about who's required to, or in situations where you don't want to have tax additional penalties due to underpayment, additional penalties to underpayment. An individual taxpayer who has estimated tax for the year of $1,000 or more after subtracting withholdings, or whose withholding does not equal or exceed the required annual payment, must make quarterly estimated payments. Okay, so estimated tax for a year of $1,000. The required annual payment is the smallest of the following: either 90% of the tax shown on the current year, or 100% of the tax shown on the preceding tax year, or 90% of the current year tax determined by placing taxable income, alternative minimum tax, and adjusted self-employment income on an annualized basis for each quarter. So basically, you're looking at make sure that at least 90% of your tax on this year's return is paid. So if I have tax due, that at least the amount that's paid in is equal to at least 90% of this year's, or 100% of last year's, to keep me from having penalties, and then or 90% of the current year's tax if you put it on an annualized basis, and we won't go through that. But just know that there's a possibility that you may have an underpayment penalty if you don't have enough withholding and you haven't made estimated payments. Those estimated payments are due on April the 15th. So the first estimated payment for 2009 would be due on April the 15th, another one on June the 15th, another one on their quarterly, another one on September the 15th, and then the last one would be January the 15th of 2010. So those 4 payments are spread over, with April, with the first estimated payment being due on the same date as the return, June 15th, September the 15th, and then January the 15th of 2010. Okay, basically just a brief explanation of FICA. Just so you can have an understanding of that if you don't already. FICA stands for Federal Insurance Contribution Act, and basically imposed Social Security taxes. That's where that comes from. It was passed in Congress in 1935. So we have FICA. There's two parts to FICA. So we have FICA, which sometimes people will see on their paycheck, or they may see it separated out. It's separated out on your W-2s when you get it at the end of the year. But you have the Social Security portion of it. And then you have the Medicaid portion of it. Medicare, because there's a difference between Medicaid and Medicare. So the Social Security portion and the Medicare portion. Okay. And so it's based on a rate of 12.4%. So Social Security represents 12.4%, and Medicare is 2.9%. 2.9%. Okay. And if you are an employer, meaning you work for someone, the way it works is that for Social Security, they withhold from your paycheck, meaning you pay half of that, which is 6.2%, and then your employer pays on your behalf, meaning it comes out of their pocket, half of it. So if you are an employee, you work for an employer, 6.2% is withheld from your paycheck and paid in, and then your employer pays the other half. Okay? Same thing with Medicare. If you're an employee, they're going to withhold half of the 2.9 or 1.45%, and then your employer would pay the other half, 1.45%. Okay, 1.45%. So you get to, it's a split. So your employer paying half and you are paying half, and they pay that in. If you're self-employed, then you need to take care of the full amounts. So if you're self-employed, you'll need to take care of the full amounts. Okay, so that's the good thing. Now, the other thing is that for 2008, Social Security does max out. Social Security maxes out on $102,000. So if you make $115,000, you're only going to be subject to Social Security or on $102,000. Okay, so $102,000. Anything over $102,000, you don't have to pay the 6.2%, nor does your employer. Okay, Medicare does not max out; it's unlimited. So if your income is $115,000, you're going to be subject to $115,000 times 1.45%, and also from your employer times 1.45%. Okay. If you have more than one job, when one job doesn't know what the other job is doing, and your max comes over to over the 102, you may end up with an overpayment of FICA, and so that would happen. And so you end up getting a credit for that against your tax liability for that overpayment. So it's possible if you have two jobs and you can't say, oh, don't withhold from me because I have another job in the combination of two. Each job is going to withhold and pay taxes based on their part of the picture, based on their part of the picture. So you could very well have an over amount. You could very well have an over amount. Okay, if you turn to page 9-17, that's where they talk about the self-employment being liable for the full amount of this 12.45% and 2.9% for Medicaid. If you look at there, it has that chart to where if you're self-employed, that's why those estimated payments are very important, and you paid on the full amount. There is some calculations to that that we won't go over, but on page 918, where you take that self-employment amount times 92.35%, and you deal with that on your taxes. So if you look at page 9-18, there's a calculation to that, a step 1 and step 2, where we look at that and we take our income times 9.35%. So it's important to look at that. And that's, I believe that's it. FUTA tax we won't deal with, which is federal unemployment tax that companies pay on your behalf, and how they pay into federal unemployment. They pay federal unemployment tax, insurance, and then so if you have to draw unemployment, then that's how that's paid, is through that insurance, which is paid. And that's it for Chapter 9. What I wanted to do is just briefly review what we've covered and what you should have, or if you haven't, you definitely need to make sure you get turned in very shortly, as the end of the course and is due. You should have a due date on your information that I sent you. And so just to be clear, so that if there's any questions, you should have completed Chapter 1, multiple choice. Okay, you should have completed Chapter 1, multiple choice. We did Chapter 1, so make sure that you complete those. And the way I work those is Chapter 1, multiple choice, is for 12 points and is based on how many points are in the multiple choice. Okay, we covered Chapter 2, so you should have completed by now Chapter 2, multiple choice. Make sure Chapter 1 has 12 too. No. Chapter 1 has 18. And Chapter 2 has 12. I was looking at Chapter 2. And we covered Chapter 3. So you should have done Chapter 3, multiple choice. And so make sure you go in and do that. And let's see. Chapter 3, multiple choice, has a number of them. And you should see in there, I'm going to put 33 points, but I'm going to limit that. So, but Chapter 3 technically has 33 multiple choice. Then we did Chapter 5. Okay. Chapter 5 was our itemized deductions and our other incentives. We didn't do Chapter 4, so you don't have to worry about Chapter 4. Okay, Chapter 5 has, let's see how many multiple choice it has, and I just do 1 point for each multiple choice, so you need to make sure you forward those to me because those points can add up. They have 26 multiple choice, and we just finished Chapter 6. So you need to make sure you do Chapter 6 multiple choice, and they have 19. Okay, and what I'll do is I may limit you to a certain ones because we didn't cover in detail everything in Chapter 3, so I don't want you to hold you responsible for those. Okay, you should have had an exam. Exam 1, which would have covered Chapters 1 and 2, which pretty detailed, so make sure you have that exam to me. Exam 2, which would cover 3 and 5, with a lot of it being from 5, with has the multiple choice. And then we will have an Exam 3 that's going to cover a little bit of everything. So you have the multiple choice, you have the 3 exams, and then you have a final return problem. Remember, you have tax cut software that came with the program, so you can do it on tax cut. You can do it by hand. Just make sure that you get that done. So we have 5 chapters of multiple choice problems. Excellent questions, so that's why I like to assign them. They're really challenging, and they should help you review the material. Exam 1 that will cover Chapter 1 and 2. Exam 2 that covered Chapter 3 and 5. And Exam 3 that was kind of like a final and overall. That's going to cover all of them, including with more questions coming from 6, which had to do with those credits. So definitely spend some time on that exam. And then the final return problem. So those are all the things that are due and should be due as you go through the material, if you have any additional questions or additional concerns as you work on your final return problem, because that's really at the point that you should be at in exam 3. By this point, because of the deadlines that I know that are in my syllabus and the information that I mail to you, the 1, 2, 3, and 5 multiple choice should be in by now. And exam 1 and 2 should be in by now. And then the only thing that you should be working at this late part of the class should be perhaps chapter 6 multiple choice, finishing up your exam 3, because as you work through the other chapters in the other exam, you should have completed those part of the exam 3. And then you should be working on your final return problem, your final return problems. You can mail those to me. At this point, you should have already sent work to me. You can email it to me. Either way, to make sure I get that information. And that's it. So if you have any questions, concerns, that takes care of basic income tax, covers everything that you need to turn in. I covered chapters 1, 2, 3, 5, and 6. Just a basic return. At this point, you should be able to prepare a basic income tax with a Schedule A and other schedules that we looked at. We looked at Schedule E for rental. We looked at the schedules A and B for itemized deductions. We looked at a lot of forms that go along with those other schedules and things we looked at. So that final return problem is going to test your knowledge on preparing a basic income tax return based on the information that we covered. Okay, that's it. Thank you, and that's basic income tax.